Welcome to the May 22nd, 2023 Advance Report for McGowanGroup clients and NetWorthRadio.com listeners. I'm Spencer McGowan, your financial weatherman with your fast-paced weekly tour of the most important topics. One of the unique things about YouTube McGowan Group is that the team of 10, McGowanGroup Wealth Management, brings you actual research. So you may see a news story and it may get you all spun up, but here's where you come to get the facts. And we're going to use real facts as we go through what's actually happening in the economy. And the headline that spun everybody up, by the way, I'm president, McGowanGroup Wealth Management. We do great investment plans for real investors serving affluent families from the Crescent in Dallas. I invite you to come down for a tour, and at the same time you can use a Zoom if you want. But what's important is that investment plan outline updated for some of the things that I'm about to show you, which will surprise you. Default. Janet Yellen, U.S. Treasury Secretary, basically the CFO of the nation, started yelling default about a month ago. And she skipped over something that's important. Alan Blinder, he's a former vice chair of the Federal Reserve, and he's also a Princeton professor. He's very much a Keynesian and very much on the left side of the political equation. He did come out with something that we've been saying at NetWorthRadio.com for a couple of months now since the debt ceiling was reached. Oh, and the biggest update this week, in a rare show of common sense, Biden and McCarthy came out and said, we're not going to default. Wow. Well, Janet Yellen skipped right over something that could be her job, and it's called a partial government shutdown that Alan Blinder chastised her for in the Wall Street Journal. He didn't do it directly because they're on the same side of the aisle, but here's the math. This is the $6.2 trillion federal budget. Now, think of the things that if you were running a company or you and I running a household, there are some things that just don't make sense. For example, borrowing $1.4 trillion. Then you hit the debt ceiling, so you're going to need $1.4 trillion to make it work with what you got. That's a CFO's job. I'll point out two categories here. So we're going to go through the categories and I'll point out two of them. There's Medicare, Medicaid, Social Security, defense, that's important, right? The military. And then there's net interest, to prevent default. You got to pay interest on the Treasury debt, which has been going up because Fed tightened. Other, $834 billion. If you ran a company and your CFO said, oh, I've got $834 billion, we're going to spend it on other. Wouldn't you want to dive into what that is? Sounds kind of unnecessary. Non-defense discretionary, $932 billion. Well, you add those two up, it's almost $1.8 trillion. Well, if you did a partial shutdown and you didn't do these things for a while, you wouldn't need to borrow. And that's the real story on the Kabuki Theater in Washington right now. And there's hope that they'll work this out and they'll prevent that dreaded default. But they've had the power the whole time, just like in The Wizard of Oz, that Dorothy had the power at any time to go back to Kansas. Okay, here we go. This is the Dow Jones Industrial Average year to date. This is the March meltdown. See, things were going okay. Then you had the banking crisis, hit a low of 31,400. Here at our investment committee, we were able to add some good bargains right down here. Wow, that helped us. And we've had a nice little relief rally since then. Now, with all the talk of default, you would think the Dow would be back here or even below, right? That's a bad thing. Well, you did descend as May approached, and you descended this week to about 33,000 on the Dow, and a relief rally ensued with a rare moment of common sense out of Biden and McCarthy saying it'd probably be best not to default. We're not going to default. Okay, so real economic growth. Here's another shocking update. And we've been bringing this update to you for the last 9 months because it is shockingly positive. 2.9% is the latest estimate by the Atlanta Fed on current economic growth. And we're already 6 weeks into the quarter. So they gather that data and they give you a good estimate. Look at this. The Bloomberg consensus on GDP was that we would be entering a mild recession. And they expected that early April. And they've come back up a little more positive since then. This has happened for 9 months where the economists are too pessimistic. You hear looming recession, and as of right now, it ain't happening. Too much pessimism. There'll be some good news in 60 days, I believe, and I'm going to show you why. Look at this. This is inflation every month. They're back after the invasion, right here. This is the invasion. And then you had elevated inflation. The high was June last year. Now we know this because July comes after June and May. So the trailing 12-month measure of inflation is going to have 2.2% fall off. So unless inflation is extraordinarily high for May and June, which it doesn't appear to be, then you're going to see the Federal Reserve measure of where they ought to be on the interest rates. They've been torturing us with the tightening cycle for 17 months now, because that raises the cost of capital, it raises the competing rates on cash, and it deflates artificially the value of investment assets. Cap rates actually going up. 9% inflation right here. That was the peak last June. 4.9% now. That's called disinflation. If you do the math, that could actually fall closer to 3% by the time we get to July. And if that happens, the Federal Reserve is too high by their own measure. They're at 5%, and 3% is a lot lower. It sets the stage for them coming back down, which created the big rally in 2019 after a quick bear market. You've heard about defaults and delinquencies, auto loans. So I went and pulled the real data, okay? This is Equifax. So this is seriously delinquent credit cards, 90 days behind. You can see, oh, this is auto loans, okay? Auto loans in 2009, and then we'll get to the credit cards. The delinquency was up here in 2009. Then it fell dramatically by 2012. Where are we now? Well, we're about in the midpoint. We're equal to the default rate of 2019. Yes, it's elevated, but we had a healthy economy 18 and 19, and you're at about the same level there. So that's not flashing a warning signal yet. Yes, there are more delinquencies than there were back in 2022 when all the stimulus checks went out. Here, you've got the Equifax serious delinquent, meaning over 90 days, 11% back in 2009, fell dramatically low to 3%. It elevated by 2019 to over 5%. Where are we now? We're at 4.57%, about the same as 2018, 2019, and maybe a little bit below average if we add that in. So that says the economy's pretty healthy. 2019 was a good economy. This is the Fed funds rate. The inflation that I showed you actually says the next step, after 4 to 6 months on average, they start to bring rates down. This is because the banking disaster happened and it was a huge recession. But in 2019, they started to come back down, and that led to a big rally. That's the stage set for 2024. Thank you for tuning in. McGowanGroup Wealth Management, serving affluent families right here from the Crescent in Dallas. A brainstorming session could help you make great decisions in the decade ahead. So find us at networthradio.com. I look forward to meeting you. Thank you for tuning in to Net Worth Media today and our efforts over the past 2 decades to educate clients and help clients make great decisions. That's the reason that we're here at YouTube McGowan Group. Apple Podcasts, NetWorth Radio, and NetWorthRadio.com. The NetWorth Media effort is designed to help you make great decisions and address value at risk of loss, fluctuation in the markets. Remember, if we talk about a security, doesn't make it a recommendation until you come down and get a plan from McGowanGroup Asset Management, the team that cares. You can set a Zoom meeting or an in-office meeting at the Crescent, and we'll give you a written plan that encompasses what we believe to be the best allocations. This is a team of 10 devoted to you. That includes the research that you see each week from Reuters, from Bloomberg, and from the best sources. We always post links at networthradio.com for what we believe can help you make great decisions, the research that comes up. Now, the NetWorth Media effort is also designed to address cycles in the market, value at risk of loss. At networthradio.com, you can get the ADV form that shows, yes, we're a fiduciary, a registered investment advisor. It covers the costs of hiring our team to help you in the future ahead. It really helps to have an expert team on your side that you can reach by phone, email, and of course, a team that's here for you every week to address what's going on in the markets, because anxiety can often lead investors to make decisions that are either dangerous, chasing things, or selling things when they shouldn't. And that's a big part of our planning effort at McGowanGroup Asset Management. Thank you for tuning in, and we look forward to serving you and your family in the years ahead.